So how does a car company watch the cost of building, every single vehicle jump by like 10,000 RMB?
Just huge.
Yeah, it's about $1,400.
Yeah.
How do they watch that happen, but then somehow manage to nearly triple their profit margin in that exact same quarter?
I mean, on paper, it sounds like a mathematical impossibility.
Right.
If your core ingredients get significantly more expensive, your margins should just compress. Or, you're forced to pass that cost on to the consumer.
Which usually totally tanks your sales volume.
Exactly.
But that isn't what happened here. So welcome to this Talk Tickers edition of The Deep Dive.
Our mission today is clear. We are tearing apart the raw transcript of NIO Inc's first quarter 2026 earnings call.
And trying to translate it.
Yes, translating the dense Wall Street jargon into plain English. We want to figure out what the underlying balance sheet is actually signaling to you, the retail investor.
No fluff.
No fluff. We're looking at the headline numbers, the mechanical drivers behind them, management's guidance, and then, rendering a verdict on the stock. Because when you review an earnings call with a CEO and a CFO just like fielding questions from institutional analysts, the real narrative can get really obscure.
Oh, totally. By financial modeling and corporate diplomacy and all that.
Right. So our job is to isolate the signal from the noise. We need to evaluate whether their capital expenditures, the R&D burn rate, and pricing strategies are actually translating into a sustainable business model.
Especially in such a highly competitive sector.
Mm-hmm.
But I actually want to reframe the premise right out of the gate here.
Okay, lay it on me.
When you hear the ticker symbol NIO, the immediate association is, a Chinese premium electric vehicle manufacturer.
Mm-hmm.
You think about cars rolling down an assembly line.
Yeah. Sure.
But as I was reviewing this specific earnings data, I realized that evaluating them purely as a metal bending auto manufacturer makes their balance sheet look, well, highly irregular.
Irregular how?
Like the thesis we need to test today is whether NIO is actually a sprawling technology, ecosystem, and energy infrastructure network that just, happens to be disguised as a car company.
That is a very different framing.
Right. Do the cold, hard facts on the Q1 ledger actually support that?
Because that framing fundamentally changes all the valuation metrics. Mm-hmm. Like if they're just selling cars, we evaluate them on unit volume and dealer inventory.
Exactly.
But if they are building this integrated hardware, software, and energy platform, then we have to look at recurring revenue, subscription retention, infrastructural efficiency, all that stuff.
And the Q1 data gives us a really clear window into which of those models is actually operating on the ground. So let's put the data on the table. Walk us through the top line reality check for Q1 2026.
All right, let's get into the numbers. So the top line reported revenue was 25.5 billion RMB.
Okay, and for our listeners evaluating this in US dollars, that translates to roughly $3.5 billion for the quarter, right?
Yeah, just about. And that represents a 112.2% increase year over year.
Wow.
Yeah. And if we drill down into the core operations, vehicle sales specifically accounted for 22.8 billion RMB of that total.
Which is a massive jump.
It is. It's a 129.2% jump compared to the first quarter of last year.
Okay.
In terms of actual physical volume, they delivered 83,465 smart EVs across their entire brand portfolio.
Okay, wait, let me stop you there. I'm going to play the skeptic for a second.
Go for it.
Because I'm looking at the quarter-over-quarter data, and there's a pretty glaring discrepancy here. You're highlighting this 112% year-over-year revenue increase.
Right.
But if I look at the revenue compared to the immediate prior quarter, like Q4 of 2025 revenue is actually down 26.3%.
Yeah.
And vehicle sales dropped almost 28% sequentially. I mean, if I'm an investor, a 26% sequential drop sets off major alarm bells. Are we looking at a stalled growth story here? Is management just, spinning a year-over-year narrative to hide a demand cliff?
No, and honestly, this is the most common trap retail investors fall into when they evaluate the Chinese retail sector.
How so?
Comparing Q1 to Q4 in China is mathematically flawed. It's due to structural calendar anomalies.
This is the holidays.
Exactly. The first quarter contains the Spring Festival, which is the Chinese New Year. And you have to remember, this isn't just a long weekend.
Right.
It is a multi-week migration and industrial shutdown. Manufacturing plants literally pause. Migrant workers travel back to their home provinces, supply chains freeze, and consumer purchasing behavior shifts entirely away from big-ticket items.
Like cars.
Right, like automobiles. No one is buying cars during that period.
So you're saying the economic engine of the country essentially goes offline for a solid chunk of the quarter?
Completely offline. And furthermore, Q4 is universally the most aggressive quarter for auto sales globally.
Because they're trying to hit end-of-year targets.
Yeah. Dealerships and direct sales networks are pushing incentives heavily to meet those annual volume targets. So you're comparing the most artificially stimulated sales period of the year against a quarter with a built-in multi-week industrial pause.
Okay, that makes sense. The sequential is basically useless here.
It is. The only intellectually honest metric for gauging actual business expansion is year over year, comparing this Spring Festival period directly against last year's Spring Festival period.
Got it. That structural context is really vital. So by that year-over-year metric, doubling deliveries is an incredibly strong signal.
Absolutely.
But top-line revenue is just vanity if you're losing money on every single transaction, you know?
Right. Revenue doesn't mean profit.
Exactly. Let's talk about the profitability of those 83,000 cars, because this is where the transcript got genuinely surprising for me.
The vehicle gross margin is basically the focal point of this entire earnings report.
Tell me about it.
So in Q1 of last year, NIO reported a vehicle margin of 7.6%.
Okay.
This quarter, Q1 2026, that vehicle margin expanded to 18.8%.
That is wild. An 18.8% gross margin in the automotive sector is incredibly high, especially for pure battery electric vehicles.
It really is.
And just to put a pin in the bottom line before we dissect exactly how they achieved that margin, their overall operating loss shrank down to 0.3 billion RMB. And if we look at the adjusted operating profit, they actually hit a positive 66.8 million RMB.
Yeah, and we should probably define that adjustment for clarity.
Oh, for sure.
Adjusted operating profit is a non-GAAP metric, meaning it doesn't follow standard, generally accepted accounting principles.
Right. What are they stripping out?
In this case, NIO is stripping out share-based compensation expenses.
Ah, okay.
Which is super common practice in the tech and EV sectors. It gives investors a cleaner view of the actual cash-generating capability of the core business operations.
Because it removes the paper expenses of stock options granted to employees.
Precisely. And by that standard, they have now posted 2 consecutive quarters of positive adjusted operating profit.
Okay, which brings us right back to that opening paradox. How do they achieve an 18.8% margin? The macroeconomic data for the spring showed severe spikes in commodity prices.
Very severe.
The CFO, Stanley, was unusually blunt on the call about the headwinds they were facing on the factory floor, wasn't he?
Yeah, he really didn't sugarcoat it. He quantified the headwind explicitly. The entire industry is currently navigating the severe cost inflation cycle for raw materials.
Like what specifically?
He highlighted 2 distinct categories causing the pressure. First, memory chips, which are the foundational hardware for their smart cabin and autonomous driving systems.
Okay.
And second, raw bulk materials, specifically lithium carbonate, NCM, copper, and aluminum.
I want to break those materials down real quick so we actually understand the mechanical reliance here.
Sure.
Aluminum makes total sense. EVs need to be light to maximize battery range, so they use aluminum gigacasting for the chassis rather than heavy steel.
Right.
Copper is essential for all the electrical wiring harnesses and the stators inside the electric motors.
Yep.
But you mentioned NCM. Let's translate that acronym. What is that?
So NCM stands for nickel, cobalt, and manganese.
Okay.
It's the specific chemical cocktail used in the cathode of high-performance lithium-ion batteries.
Why use NCM instead of the cheaper alternatives?
NCM batteries are favored for premium EVs because they offer much higher energy density than the cheaper, say, lithium iron phosphate alternatives.
And higher density means longer driving range.
Exactly. But nickel and cobalt are highly volatile commodities. They are subject to intense geopolitical supply chain pressures.
I can imagine.
So when the spot price of NCM spikes, the cost of the most expensive component in the car, the battery pack, just surges.
And the CFO stated that the combined inflation of all these materials added a 10,000 RMB penalty to every single vehicle they produced.
Yeah, 10,000 RMB per car.
That is roughly $1,400 just evaporating from the gross profit line on every car rolling off the line.
It's a huge hit.
So if my underlying costs increase by 10,000 RMB per unit, my margin should theoretically collapse. What were the specific levers management pulled to not only absorb that penalty, but push the margin all the way up to 18.8%?
Right. They executed on 2 distinct operational strategies to pull that off. The first is a highly favorable product mix.
Okay, product mix.
Yeah, in automotive accounting, the fleet-wide vehicle margin is really just a weighted average of every model sold.
Makes sense.
And in Q1, their flagship SUV, the all-new ES8, performed exceptionally well. The ES8 is a premium, high-margin vehicle.
How high?
On its own, it commands a vehicle margin exceeding 20%. And management noted that this single model contributed 50% of the total vehicle margin for the entire quarter.
Wow, half the total margin from one model. That really highlights the defensive value of premium brand positioning, right?
Oh, absolutely.
Because if you're a volume automaker selling budget compact EVs with these razor thin, like 3% margins.
You're dead in the water.
Yeah, a 10,000 RMB commodity spike is catastrophic. Yeah. It wipes out your profit entirely and forces you to sell at a loss just to keep the factory lights on.
Exactly. But if you have pricing power, if you are selling to a demographic that is somewhat price inelastic, you have this built-in financial shock absorber.
So it creates a buffer. By selling a higher proportion of their most expensive inventory, they basically lifted the mathematical average of the entire fleet's profitability.
Yep, effectively neutralizing that material penalty. But, relying solely on product mix is risky.
Because consumer tastes can shift.
Exactly. So the second margin driver is far more structural. And this is what connects directly back to your thesis about NIO being a technology ecosystem rather than just a traditional automaker.
Ah, okay. You're talking about the other sales category on the balance sheet.
I am.
This is a line item that is so easy to skim past, but it hit a gross margin of 20.6% in Q1. That is a 4-year high for that category.
That's a massive number.
We really need to unpack what is actually inside that other sales bucket because it represents this major transition from one-time transactional revenue to recurring lifecycle revenue.
Yeah, the other sales category is a mix. It encompasses their after-sales service network, auto financing, the NIO lifestyle accessory business, and most importantly, their power solutions and software subscription services.
All right, let's focus on the power solutions because NIO has taken a wildly divergent path from the rest of the industry here.
They really have.
Almost every other EV manufacturer out there relies on consumers, plugging their cars into charging pillars. But NIO has spent billions building this network of battery swap stations.
Right. You drive into a bay, a robotic system unbolts your depleted battery from the chassis, swaps in a fully charged one, and you drive away in like 3 minutes.
And for years, financial analysts heavily criticized this strategy. They called it a massive, unsustainable capital expenditure, basically a cash furnace.
Yeah, the street hated it. But the narrative around those swap stations is really shifting based on the Q1 data.
How so?
Management reported operating 3,916 power swap stations globally. But these are no longer just viewed as customer convenience centers. They've actually evolved into distributed energy storage facilities.
Oh, wow.
Yeah, the CEO discussed how they are actively utilizing these stations for grid interaction and off-peak charging.
Okay, I want to break down the mechanics of that because this is where the infrastructure play becomes really visible to the investor. They're essentially engaging in energy arbitrage. Right?
That's exactly what it is. It's called vehicle-to-grid or V2G technology. It allows these swap stations to act as a massive decentralized battery.
Right, because electricity prices fluctuate based on demand.
Exactly. So at 2 a.m., when industrial demand is super low and everyone is sleeping, electricity is incredibly cheap.
Dirt cheap.
The swap stations purchase power from the grid during these off-peak hours to charge their massive inventory of batteries. Then, during peak hours, say 4:00 p.m. to 7:00 p.m., when grid demand surges and electricity prices spike, the swap station is deploying those batteries to customers.
No, they're acquiring the energy at wholesale midnight prices and monetizing it through the customer subscription at a premium.
Yep.
All while actually easing the strain on the municipal power grid. I mean, they are functioning like a localized utility company.
They are. Furthermore, they can actually sell surplus stored power back into the grid during peak demand events.
Wait, really? They sell it back?
Yeah. This dynamic energy management drastically lowers the operating cost of the entire swap station network. It transforms a pure infrastructure expense into a revenue-generating asset.
And that directly contributed to that 20.6% margin in the other sales category.
Exactly. It's brilliant.
The other component of that high margin is software. Let's talk about the Advanced Driver Assistance Systems, or 8As.
Okay, yeah.
Software is essentially a zero marginal cost product once the R&D is actually complete. Every time they activate a subscription, it flows almost entirely straight to the bottom line.
And the CEO specifically highlighted the adoption rates of their ADA software. The really interesting data point here isn't even just new car buyers.
Oh, who is it?
NIO offers trial periods to the primary owner, sure, but they are seeing significant subscription uptake in the secondary market.
The used car market.
Yes. When a used NIO vehicle changes hands, the new owner is frequently opting to activate and pay for the autonomous driving features.
Because the hardware, like the cameras, the LiDAR, the computing chips, it's already physically installed in the car.
Right. Turning it on for the second or third owner requires absolutely zero additional manufacturing costs for NIO.
That is just pure profit at that point. This really clarifies their overarching strategy, because the broader Chinese EV market is currently engulfed in this fierce price war.
Brutal price war.
Competitors are aggressively slashing the sticker prices of their cars just to maintain market share and keep their production lines moving. But NIO has stubbornly refused to participate in those aggressive discounts.
They've held firm.
Yeah, they are holding the line on their premium vehicle pricing, using the ES8 to anchor their hardware margins and supplementing their bottom line with a 20.6% margin on energy and software services. It's the classic razor and blades model.
It is. They are fiercely defending their brand equity because engaging in a price war trains the consumer to view your product as a commodity. They just wait for the next discount before purchasing. NIO's strategy completely relies on the consumer viewing the vehicle as an entry ticket to this exclusive ecosystem.
All right, so that covers the historical performance and exactly how they navigated that Q1 inflation shock. But as we know, the market assigns valuations based on future cash flows.
Always looking forward.
Let's pivot to management's guidance for the second quarter and the remainder of 2026. What are the operational targets they've communicated to the street?
So the Q2 delivery guidance is set between 110,000 and 115,000 units.
Okay, and to contextualize that implies a year-over-year growth rate ranging from roughly 52% to 60%. Right.
They are forecasting a very rapid acceleration out of that seasonal Q1 dip.
But scaling from 83,000 units to potentially 115,000 units in a single quarter, that places tremendous strain on manufacturing logistics, quality control of the supply chain, everything.
It does.
And as we just discussed, the volume isn't the metric that determines survival here, profitability is. Did the CFO provide specific guidance on where the vehicle gross margin will land while they are scaling this rapidly?
He did. And honestly, this was the absolute focal point of the Q&A session with the analysts.
I bet.
Because that 10,000 RMB raw material penalty for memory chips and lithium, it hasn't disappeared.
Right.
Stanley acknowledged that this commodity pressure is going to persist straight through Q2, yet management explicitly committed to targeting a full-year vehicle gross margin of 17% to 18%.
Okay, I have to challenge the math on that. If the underlying cost of your core components remains elevated, how do you mathematically maintain an 18% margin on 115,000 cars?
It's a fair question.
You either have to raise the price of the car, which they said they aren't doing to maintain volume, or you have to find severe cost savings somewhere else in the manufacturing process. Did they explain the mechanics of this margin defense?
They did. They detailed a three-pillar strategy. The first two are basically continuations of what worked in Q1, so pushing the high-margin product mix and maintaining that stable, non-discounted pricing.
Okay, and the third?
The third pillar is an operational initiative they have termed the transparent supply chain.
Transparent supply chain. I mean, come on. That sounds like the kind of vague corporate synergy buzzword that gets thrown around on earnings calls just to placate analysts without providing any actual detail.
It totally sounds like jargon.
What does that actually mean on the factory floor?
It is actually a highly invasive auditing process. So traditionally, an automaker treats a tier 1 supplier as black box.
Right, they just order the part.
Yeah. The automaker requests, say, an electric window motor, and the supplier quotes a price. The automaker might try to negotiate that price down, squeezing the supplier's profit margin.
Sure, standard vendor negotiation.
But NIO's transparent supply chain approach involves sending their own engineers directly into the supplier's manufacturing facilities to audit the entire life cycle of the component.
Wait, they're looking at the supplier's internal books and processes?
Yes, with the supplier's cooperation, of course.
Wow.
They're analyzing the raw material sourcing, the manufacturing cycle time, the labor costs, and the logistics.
Okay, looking for inefficiencies.
Exactly. The goal is to identify non-value-adding costs. So, for example, if a supplier is shipping a subassembly in 3 separate, heavily packaged boxes to the NIO assembly line, An NIO engineer might look at that and redesign the packaging to fit all the components into a single reusable crate.
Oh, I see.
This saves the supplier money on cardboard, foam, and freight logistics. And then NIO captures a percentage of that efficiency saving as a lower purchase price for the component.
So rather than just demanding a 5% discount and eroding the supplier's business health, they are engineering the 5% discount out of logistical waste.
Yes, exactly.
That is a structurally sound approach to cost reduction. Did management actually quantify how much they expect to save through this auditing process?
William Lai, the CEO, stated that through this engineering optimization, they have identified opportunities to cut 5% to 10% of non-value-adding costs from their supply chain.
Okay.
And that specific 5 to 10% efficiency gain is the mechanism they intend to use to offset the ongoing 10,000 RMB penalty from the memory chips and the lithium.
That definitely answers the margin question, provided they can actually execute those audits successfully.
Right. Execution is key.
But to hit the 115,000 delivery target, they still need a catalyst for demand. Let's evaluate the product pipeline. They're introducing a significant amount of new hardware. What is the flagship release that investors should really be tracking right now?
The primary catalyst is the all-new ES9. This is their flagship executive SUV. It was unveiled in April and officially launches to the market in late May.
Okay, and what's the price point?
The pricing is significant. It starts above 500,000 RMB.
500,000 RMB. That puts it at roughly 70,000 US dollars. This is no longer the premium middle market. This is the true luxury segment.
Oh, absolutely.
What is the demographic they are attempting to capture at that specific price point?
Management was completely unambiguous about their targets. The ES9 is engineered to compete directly with the internal combustion engine luxury stalwarts.
Like who?
The CEO specifically named the BMW X7 and the Mercedes-Benz GLS as their benchmark competitors.
Okay, those are heavy hitters.
They are positioning the ES9 as the vehicle that transitions the high-end, chauffeur-driven executive market into the pure electric era.
I see a glaring strategic risk here, though, and an analyst on the call brought it up as well.
Cannibalization.
Yes. Let's look at the psychology of the showroom. We just established that the ES8, which is a large premium SUV, was the hero of Q1, generating half of their vehicle margin.
Yep.
Now, just a quarter later, they are launching the ES9, which is an even larger, even more premium SUV. If I am an affluent buyer in Shanghai walking into a NIO house, why would I purchase the ES8 when the ES9 is sitting right next to it?
It's the innovator's dilemma.
Exactly.
Right.
Isn't management just cannibalizing their own successful product line?
Yeah.
Are they just spending millions in marketing just to shift an existing customer from one seat to another?
It is a totally valid concern, but the data management provided suggests the exact opposite phenomenon is actually occurring.
Really?
Yeah, the pre-launch phase of the ES9 did not suppress ES8 sales at all. Instead, it basically functioned as a top-of-funnel marketing mechanism.
Interesting.
The sheer technological spectacle and all the media coverage surrounding the ES9 drove unprecedented foot traffic into their retail locations.
But showroom traffic doesn't pay the bills. You know, people will always line up to look at a halo car. Does that foot traffic actually convert into sales for the broader lineup?
According to the transcript, yes, it does. Once the potential buyers are in the showroom, the sales associates help segment them based on their actual use case.
How so?
Well, the ES9 is massive. It's an executive flagship designed primarily with rear seat comfort in mind for buyers who actually utilize chauffeurs. It's a direct alternative to that Mercedes GLS.
Right.
But the ES8 is slightly smaller, it's more dynamic to drive, and it's positioned more as a dual-purpose vehicle for both professional commuting and family travel.
Got it.
And the CEO reported that after the ES9 test drives commenced in early May, order intake for the ES8 actually increased by 30% week over week.
Wow, a 30% increase. So that is the halo effect in action. The ES9 serves as the bait to get the consumer into the ecosystem, and the sales team directs them to the ES8 if the executive layout doesn't actually fit their lifestyle.
Exactly.
If both of those high-margin SUVs maintain volume, that 18% margin target seems increasingly defensible. But, you know, the luxury segment alone won't get them to 115,000 deliveries a quarter. They need a volume engine. Where's the mass market growth coming from?
The volume catalyst is the ONVO brand.
ONVO.
Yes, which is their mainstream family-focused subsidiary. And the critical launch here is the ONVO L80. It's a large 5-seater family SUV.
Okay.
William Li highlighted a really interesting demographic reality of the Chinese auto market. The total addressable market for 5-seater SUVs is 3 times the size of the 3-row SUV market.
3 times larger. I mean, that is the fat center of the Chinese middle class right there.
Precisely. And the L80 is specifically engineered for that exact demographic. They highlighted that it offers the largest cargo capacity among 5-seat SUVs in China, and they're focusing heavily on scenario-based lifestyle solutions.
What does that mean, scenario-based?
Things like integrated camping features, pet-friendly cabin layouts, family road trip ergonomics, stuff like that.
It is a classic tiered brand strategy. The main NIO brand, with the ES8 and ES9, acts as the high-margin anchor, establishing the premium reputation.
Yep.
And the ONVO brand leverages that technological reputation, but targets the massive volume of the middle class. And they still have their compact brand, Firefly, right?
Yes, which already commands like 2/3 of the premium small car segment.
They have effectively blanketed the entire consumer spectrum.
They have, but having a vehicle in every segment only works if the underlying technology provides a competitive moat.
Right. If it's all the same generic tech, it doesn't matter.
Exactly. If the software and hardware inside the ONVO are identical to what a consumer can buy from a cheaper competitor, the tiered strategy collapses. We have to examine their R&D and their proprietary technology stack.
And this might actually be the most crucial long-term indicator in the entire transcript, the tech moat. Let's talk about the silicon.
The silicon is key.
The CEOs spent a significant amount of time detailing the NX9031. What is this, and why should an auto investor care about semiconductor nomenclature?
So the NX9001 is NIO's in-house developed autonomous driving chip. And the defining specification is that it is an automotive-grade 5-nanometer smart driving chip.
Okay, let's pause and provide an ELI 5 and explain like I'm 5. For the listeners who aren't semiconductor engineers, what does 5 nanometer actually mean, and how does shrinking a piece of silicon translate to an advantage on a corporate balance sheet?
Sure. So in chip manufacturing, the nanometer measurement refers to the size of the individual transistors on the silicon wafer.
Okay.
The smaller the nanometer rating, the more closely those transistors can be packed together. And when transistors are closer, electrical signals travel shorter distances.
Making it faster.
Right. It processes data significantly faster, and crucially, it requires far less electricity to function, which means it generates less heat.
And in an electric vehicle, electricity is literally your most precious resource. If your central computer is drawing massive amounts of power to process camera and radar data, it is actively draining the battery and reducing the driving range of the car.
Exactly. Getting a chip down to 5 nanometers is exceptionally difficult, even in the consumer electronics space like smartphones. But it is exponentially harder for automotive application.
Because of the environment.
Yeah. An automotive chip has to survive extreme temperature fluctuations, constant physical vibration, and it has to guarantee zero latency reliability for safety systems. You can't have a crash.
Right.
Most legacy automakers are relying on off-the-shelf chips from suppliers like NVIDIA or Qualcomm that are built on older, larger node architectures. They draw more power and offer less integration.
So NIO isn't just buying hardware. They are designing the silicon from the ground up. Is this still in the prototype phase, or is it actually on the road?
No, it is actively scaling right now. They began mass production of this chip in the ET9 model back in March of last year, and they've shipped over 250,000 units.
That's significant volume.
It is, but the forward guidance is the real story here. Management projects that by the second half of 2026, 80% to 85% of all vehicles produced across their entire brand lineup will be equipped with this proprietary 5-nanometer chip.
Okay, but designing a 5-nanometer chip requires hundreds of millions of dollars in R&D. Why take on that immense capital burden instead of just buying a proven NVIDIA chip like everyone else? Where is the return on invested capital there?
The return comes through vertical integration and structural cost reduction. By owning both the silicon design and the autonomous driving software, they can perfectly optimize the two to work together.
Right.
They utilize an AI architecture they call the New World Model, or NWM, which relies on closed-loop reinforcement learning.
Okay, closed-loop reinforcement learning. That is some dense AI terminology. Let's translate that. Are we basically saying that the car is grading its own homework while it drives?
That is actually an excellent way to conceptualize it. In traditional autonomous development, a car encounters a complex scenario, records the data, and sends it back to a massive centralized server farm, where human engineers and supercomputers process it, write an update, and send it back to the fleet. It requires an immense amount of cloud computing power.
And renting those cloud servers is a massive ongoing operational expense for an EV company.
It's one of their largest recurring costs. But because NIO's 5-nanometer chip is so powerful and perfectly tuned to their specific neural network, the car itself handles more of the learning and processing locally.
Oh, wow.
Yeah. William Lai stated that this integrated system only requires 20% of the cloud computing power that their competitors use to achieve the exact same autonomous performance.
Wait, 20%? So they have engineered a system that cuts their cloud server bills by 80%.
Yes.
That is a staggering structural advantage.
Yeah.
And that flows directly to the bottom line year after year.
Furthermore, deploying one unified chip architecture across the premium NIO brand and the mass market ONVO brand accelerates their data collection.
Because more cars are on the road gathering data.
Right. Every single car they sell, regardless of the price point, is feeding data back into the same unified neural network. The system gets smarter, faster, at a much lower cost per mile than a competitor using fractured, off-the-shelf hardware.
That R&D efficiency is so critical because an analyst directly questioned their operational expenditure. They are targeting an R&D spend of roughly 2 to 2.5 billion RMB per quarter. How do they ensure the capital isn't just being wasted on redundant projects?
The CFO addressed this by explaining their organizational restructuring, which they call the CBU mechanism.
What's that?
They've streamlined their internal R&D workflows to eliminate bottlenecks and redundancies. Stanley asserted that their current 2 billion RMB spend is yielding the equivalent technological output of a 3.5 billion RMB spend in previous years.
So they are extracting way more innovation per dollar.
Exactly. And a key factor here is their focus. They are a pure battery electric vehicle company. They are not diluting their R&D budget by simultaneously trying to develop internal combustion engines, plug-in hybrids, or range extenders.
Every single engineer is focused purely on advancing the EV and autonomous tech stack.
Right.
Okay, so we've analyzed the raw numbers, the macroeconomic headwinds, the margin defense mechanisms, the product pipeline, and the underlying silicon architecture. It is time to synthesize these components and establish the bottom line.
Let's do it.
Based on the transcript and all the strategic indicators we have discussed, what is the actionable takeaway for the retail investor right now?
When you aggregate the data, the 18.8% vehicle margin achieved during a massive commodity inflation cycle, the 20.6% margin on ecosystem services, the proprietary 5-nanometer silicon advantage, and the disciplined execution of the transparent supply chain, the trajectory of the company is demonstrably positive.
So you're bullish.
My assessment is firmly bullish. The operational maturity displayed in this quarter really separates them from the volume-chasing competitors engaged in margin-destroying price wars.
I totally share that bullish verdict, and I want to outline the specific, actionable reasons why for the listener evaluating their portfolio.
What stands out to you?
The most compelling evidence in this transcript is the undeniable proof of pricing power. In an industry where consumers are increasingly treating EVs as generic commodities, NIO is maintaining a premium aura. In Q1, their average selling price, their ASP, was 390,000 RMB.
We really need to contextualize that ASP to understand its significance. At 390,000 RMB, the average NIO vehicle is selling for 50,000 RMB more than the average BMW sold in China.
Wow.
And roughly 50% more than the average Audi. The CEO noted that in key economic regions, specifically Shanghai and the broader Yangtze River Delta, NIO's market share has actually surpassed the internal combustion engine market share of these legacy German luxury brands.
That is a complete seismic shift in consumer psychology. I mean, for decades, a BMW or Mercedes was the default status symbol for an affluent consumer in Shanghai.
And that paradigm is breaking.
Consumers are increasingly viewing NIO not just as an equal, but as the superior technological and status choice. That brand equity is an intangible moat. You can reverse engineer a motor, but you cannot easily replicate cultural cachet.
You really can't.
That is why they can maintain an 18% margin while others bleed cash.
The second pillar of the bullish thesis is the balance sheet runway. They are demonstrating a clear path to sustained non-GAAP profitability, targeting a positive full-year operating profit for 2026.
Right.
But they are undertaking the scale-up with an absolute fortress of a balance sheet. They concluded Q1 with a cash reserve of 48.2 billion RMB.
And for context, that is roughly $6.7 billion in cash, equivalents, and short-term investments. In a capital-intensive industry facing major macroeconomic uncertainty, cash is oxygen. It means they have the internal liquidity to fund their 2.5 billion RMB quarterly R&D habit, to roll out the ES9, and to expand their battery swap network without being forced to tap the debt markets at currently unfavorable interest rates. They dictate their own timeline.
However, a bullish thesis requires constant verification. An investor cannot simply buy the stock and ignore the quarterly reports.
Good point.
We need to identify the specific metrics that will either validate or invalidate this narrative in the coming months. What should our listeners be scrutinizing when the Q2 earnings are released?
Well, I am circling two specific metrics for the Q2 report. Number one, the ES9 delivery volume and conversion rate.
Okay.
Management has set an incredibly high bar, claiming the ES9 will drag the chauffeur-driven executive market into the EV era. I need to see the early delivery figures.
Because foot traffic isn't enough.
Right. Showroom foot traffic is a great leading indicator, but I want to verify that the 500,000 RMB price tag is actually converting test drives into registered vehicles. If the ES9 launches successfully and scales, the margin profile of the entire company elevates significantly.
And if it stalls?
If it stalls, it suggests they may have hit the ceiling of their pricing power.
That is the crucial top-line metric. On the operational side, the number to track is that 17% to 18% vehicle gross margin target.
Right. Can they hold it?
We've established that the commodity inflation penalty for memory chips and NCM battery components is actively impacting them in Q2. Management is entirely reliant on their transparent supply chain audits to wring 5% to 10% in cost savings out of their logistics network to offset those material costs.
So if it holds in that 17 to 18% channel, it proves that their supply chain optimization is real and effective.
Exactly. But if the margin compresses back down toward 10% or 12%, it indicates that the raw material inflation overpowered their engineering efficiencies and the margin defense narrative begins to fracture.
Monitor the ES9 volume and monitor the resilience of the 18% margin. If both of those metrics hold steady, the transition from an automotive startup to a sustained, profitable technology ecosystem is fundamentally validated.
I completely agree.
This brings us to the conclusion of our analysis. I want to leave you, the listener, with a final concept to consider as you evaluate the broader landscape of the EV sector. We began this discussion by questioning whether NIO is a car company or a tech ecosystem.
Right.
Consider the trajectory of their operations. They are deploying proprietary, highly efficient 5-nanometer silicon into millions of vehicles, creating a massive closed-loop neural network that constantly refines autonomous driving data.
Yep.
They're cultivating an active secondary market for high-margin software subscriptions, and they are operating a network of nearly 4,000 robotic battery swap stations that are actively engaging in vehicle-to-grid energy, arbitrage buying cheap off-peak power, and stabilizing municipal electrical grids during peak demand.
It's so much more than just a car.
So when you purchase shares of this company, are you simply investing in an automaker trying to sell metal boxes? Or are you buying into an expanding neural network with 4 wheels attached and the foundational energy infrastructure of the future electric economy?
It really forces a total reevaluation of the traditional automotive business model. The vehicles themselves may simply be the hardware nodes required to facilitate a much larger, recurring software and energy network.
It is a dynamic worth monitoring very closely. Thank you for joining us for this extensive teardown on Talk Tickers. Our goal is always to help you filter out the noise and focus on the fundamental mechanics driving the balance sheet.
Keep looking past those headlines.
Absolutely. Keep questioning the consensus, and we will see you on the next deep dive.